Good morning, ladies and gentlemen. I'd like to welcome you to another exciting webinar from Sable International. So before I get going, just by way of introduction, my name is Andy Rissick. I'm the Group International Director and very involved in the real estate business, which is what we're really going to be focusing on today. But before we jump into the detail of the actual webinar, firstly, to thank you all for taking time out of your busy day, and I hope you find today enjoyable. Just a little bit of housekeeping. On the right-hand side of your screens, you'll see a little area where you can actually ask questions, and I'd really encourage you to ask questions of any of the panelists whilst they're speaking, and even if you think your question is silly, it's always good to ask. There are lots of other people who learn from those questions. So we'd encourage you to do that. And we'll just try and keep it sort of as informal as possible. And we'll do a little Q&A at the end if necessary. So a little bit about Sable International. For those of you who don't know our business, we've been around for over 26 years now. And we specialize in internationalizing people, their wealth, and their businesses. So we have a very strong offering across many disciplines within the cross-border space. So we help people with immigration. We help people relocate to countries predominantly in the Anglo-Saxon world. We do a lot of work into Europe. We have a foreign exchange business, so we can help people move money very cost effectively rather than using your own bank. And actually quite important, strong tax knowledge in-house, which we'll be talking about a little bit later. It's really important when you're putting a border between yourself and your investment to understand the potential tax implications, and that'll all be dependent on your tax residency. So we have those skills in-house as well. And then what else do we do? We've got an accounting business. We've got one of our chief accountants on the call today who will be talking about tax as well. So I think that's enough about the business. Today, we're going to be talking about real estate investment, and we really want to just introduce to you our advisory service that we started up at the beginning of 2022, a very exciting addition to the suite of Sable services. And we're going to just explain how we approach the offshore markets and how we can help you in your diversification strategy, and also to make sure that when you're investing offshore that you are making a good investment, because there are lots of risks out there. So before we jump into the meat of the webinar, you'll see all these black and white faces at the middle of the screen, and they're all in color at the top. So as I mentioned, I'm the Group International Director. I also look after the real estate business, as well as our investment migration business, and also one of the foreign exchange businesses. So I tend to work more on the investment side. And then with me today in the studio, we've got Megan, Scott, and Sarah. And I think what I'll do is just ask Megan if you can unmute yourself and maybe just give a quick introduction and a little bit about your experience.
Thanks, Andy. So I'm Megan Copley. I'm building the real estate investment department alongside Andy. I have a long career so far in property abroad, working in the UK and in Europe for some major businesses, both professional real estate services at Savills and in a family office for John Caldwell, a UK billionaire. I moved to South Africa a year ago to start this and to help South Africans to buy property overseas in a responsible manner.
Thanks, Meg. Sarah, maybe a quick intro?
Sure. So my name is Sarah Young. I'm originally from the UK, but I've lived in South Africa for 12 years now. And I came on board with Sable around 3 years ago, and I head up their investment migration department. So assisting clients to look at opportunities to secure second residency or citizenship through investment. A portion of that which can be achieved sometimes through real estate. And so we'll chat a little bit about that a bit later. Thank you.
Thanks very much. And last but not least, Scotty Brown.
Good morning, everyone. My name is Scott Brown. I'm not in South Africa. I'm actually in London. And as you probably can also hear, I'm not English or a South African, but a Kiwi. I've run the accountancy side for Sable I've been there for over 20 years. And today I'll be taking you through some of the tax and accounting situations that you'll find if you're looking at investing in real estate within the UK. So look forward to that.
Thanks, Scotty. So I hope you all agree we've got some very diverse skills on the panel today, and hopefully you'll pick up a lot of knowledge from our various specialists. So just a little bit about the agenda today. Why choose offshore property, and more importantly, once you've made that decision, the things that one needs to consider when investing offshore. And also, we're going to talk a little bit about investing for resilience and the approach and the strategy that Sable has in assisting you as clients to make sure that you have a clear strategy to actually build a portfolio, and we try and mitigate as much risk as possible. And then Scotty's going to be talking about the tax and the sort of structures that one can invest through to try and create tax efficiencies. And I suppose there's probably a threshold at which one would consider, either investing in your personal name or structures. And those are always very interesting conversations. So I'm sure there'll be a few questions around that. So what I'm going to do now is I'm going to hand over and let Megan just talk you through the actual real estate journey. So Meg, over to you.
Thanks, Andy. Hi, everyone. Welcome. Thanks for joining us today. I hope my sound's okay. So I would like to talk you through a little bit about why we consider buying property overseas. This is a great conversation I have with our wealth team here at Sable, and to understand, what the diversification is for your investment portfolio and why you might do it. Physical property has historically given professionals, investors, a sense of financial stability, and retaining that investment exposure by making a monthly payment is actually a constant reminder of that stability. And then, of course, volatile cash flow. When you're gearing an investment, it's great to have a rental agreement in place, which also contributes to that financial stability. So, this is why we recommend property alongside your investment portfolio for a great way to diversify, but for financial stability. Some of the considerations. So these are the fundamentals we look at when suggesting property. Why you invest in property, why it is something you can look at as a robust financial investment to add to your portfolio. Bricks and mortar itself, people will always need somewhere to live, work, or store goods. So the fundamentals of property are there. Looking to offshore property offshore your wealth outside of South Africa into property is, a major consideration is in what currency you'd like that asset to be underwritten in. Dollars, euros, pounds, those more robust currencies with, with historic strength is probably where you want to go. A lot of the time when buying property overseas, people might consider taking out a loan. Interest rates are far lower in the UK and in Europe than they are in South Africa. Obviously, this adds to the overall investment case and helps us to understand why we would buy property overseas, what a yield looks like, and what a positive return can look like. At the moment, interest rates are a little bit higher. Obviously, they're going up. Bank of England, Euribor. We'll come on to that in a minute. Another consideration, major fundamental is the supply and demand. We would look at this, on your behalf, but it's not just about buying property anywhere in the world. It's about looking at locations, understanding what the historic supply has been. If there's a shortage of housing, which we know there to be in the UK and other parts and other cities in Europe, then a demand is there. And is there a demand for tenancies? You are looking for, when looking for a robust investment, your future tenancy is a major consideration. That's your monthly yield. So is there a demand for places to live? Is that putting upward pressure on your rents? That's what you're looking for. So that's part of our expertise, is advising and around the globe about where we see pockets of value or pockets of opportunity. Tenancy options and tenant profile are also a major consideration when buying property. What types of tenants will you get? A short-term holiday let is one option. A long-term working professional who's possibly looking to get on the property ladder themselves. That's a reliable tenant who's unlikely to miss their monthly payments because they're keeping their credit score, good. Or are you looking for university students? So you're in a university town. Those types of tenancies often pay their rent in advance, which is obviously another way to de-risk the property ownership or your yield. So, these are major considerations as well. Property management and ongoing maintenance of the property. This is, this is an area where, as a foreign investor who's far from their asset, you need to ensure that you're in an established market where this service is available to you. It might sound silly, but property management, proper established property management is not available everywhere. And we know the UK offers a very established rental foreign investment market, but there throughout Europe and other cities, these are considerations, and ongoing maintenance as well. Overseas costs versus what it might cost here, it may not be comparable for certain things. So that's where you need a good property manager to ensure that your assets looked after and maintained. And price growth. This is another area that we'll look at. What are the historic factors that drive price increases in property? Migration of people, movement of people to areas, why that happens, government regeneration, major infrastructure changes, which makes transport easier. People can move further out because they can come back into city centres in less time. So transport, or the movement of offices or workforce, or creating microeconomy in different areas where people can live and work. These are factors which will drive price growth, and that's something that we do a huge amount of research as a business into finding out where we see these opportunities. And finally, and a really major point to consider, especially as South Africans, if you are living in South Africa, is a property asset is a robust asset that can be passed down through generations. Rental income does tend to increase, in the right locations based on the considerations we've mentioned above. In areas where there is high rental demand, you get year-on-year increases. Those move with inflation generally, and can offer a great yield to generations to come, as well as having a property which you hope to also grow in value and keep in value, in touch with time value. So those are some considerations. And here we've just got a few points of interest. I think Andy will speak a bit to this with me. He's recently spent a lot of time having a look at the Portuguese property market as well, which is an area that we focus on too. Some points to consider when looking at property overseas is, the Bank of England interest rate has recently risen to 2.25%. We do foresee that will continue to rise, or certainly the Bank of England has told us that much, and that is the prediction. This will affect your lending, and will affect how much you can borrow on a mortgage. And mortgages, for those of you that don't know, are available in Europe and the UK to South African residents. So that isn't widely known. The UK mortgage market is, a market to consider, to talk about. It's an extremely established market. It's not just banks. There are 87 different types of lenders in the UK that lend, on these properties, on these assets, to foreign investors, so those outside of the UK. This is because it's moved away from banks. It's become a private sector. There are institutional investors backing lenders. There are retirement funds backing lenders. So yes, the Bank of England interest rate matters, but what's important to think here is that this is actually a private sector lending. So at the moment, it might be difficult to get a mortgage in the UK because of the rises in interest rates. We know that this will be coming back soon because these are private institutions. They're working out their margins, and they will be back to offer fixed rate mortgages to foreign investors who are looking to buy property in the UK. Interest rates in the UK, the Euribor, that has gone up as well. Unlike the UK, most mortgages in Europe are offered by banks. In some parts of Europe, pension funds have entered that market. So fixed rate mortgages, or mortgages of variable rates, are still available to investors in Europe. And the cost of that capital is still relatively cheap, certainly when comparing it to South Africa. So, yeah, I mean, talk to us. We can help you, and we can put you in touch with mortgage advisors who can assist you if you are looking to buy property and take out lending. Andy, I think this is an important point for you to come in here. Talking about the robustness of the Portuguese city property market, which is seeing huge cash investment from dollar investors. Andy, tell us more about what you said.
Yeah, I think, look, I've just come back from spending 4 or 5 months in Europe, most of it in Portugal, to the UK. And I think if you read the media globally, it's pretty negative. And what I've noticed since the re-emergence of humanity on the move again after COVID is, in every country, people were quite aggrieved the way their governments managed the lockdowns, etc., etc. There are all sorts of other destabilizing factors that are happening in sort of so-called first world economies that, relative to South Africa, are actually not really big problems, but relative to people who are not used to problems, they feel like real problems. And what we're seeing in Portugal at the moment, and particularly in the really high value areas, is a massive surge of American investment. The American dollar is extremely strong at the moment. I mean, they're getting a 20 to 25% discount if they invest into the UK at the moment. And if they're investing into Europe, probably closer to 20%. But it's unbelievable. They've got strong buying power, but there are a lot of wealthy Americans who are very unhappy about the political situation in the US. And ironically, we're seeing so many South Africans moving to the US. So there's this kind of perception globally that the grass is greener on the other side. But I think what we've got to understand from an investment perspective is that volatility and uncertainty create human movement. And with that actually comes a lot of opportunity. So you've got Americans who are genuinely looking to diversify now and diversify out of the US in all sorts of ways, and it's certainly driving the Portugal market. The other thing about the Portugal market that is really interesting is that there are lots of other very wealthy European countries that have got very high tax rates, and a lot of those individuals are actually moving to Portugal because there's a really interesting tax regime which gives them a 10-year tax holiday. These are all the things that we go out and understand are driving a market. And I was trying to rent an apartment on a short-term basis in the Lisbon area, and for 3 months there was not a single apartment available. I mean, it's crazy and good to know what's going on. And again, it comes down to areas, because you'll go to other parts of Portugal where there's absolutely no demand. So it's about understanding the pockets of desirable real estate, really.
Yeah, thank you, Andy. And that actually is a really good point. Brings me on to the next one. I've made this about the UK, but there's housing shortages, around Europe, and in the UK. These are major considerations when you are looking to buy property overseas, because in terms of what we can see in the foreseeable future, where banks are going to tighten up mortgages for homeowners, or lenders are going to tighten up mortgages for homeowners, this will drive the rental market. So foreign landlords, can reap the benefits of this. Basically, we've seen rents climb in London and the UK, extraordinarily in the last year, just post-COVID. In Lisbon as well, rents have been climbing. Lisbon has been promoted to what you call an alpha city of Europe. It's driving workforce into Lisbon. It's an amazing lifestyle. Other like-minded individuals in this tech nomad space, again, driving rentals. So these are points that we look at when looking for markets and opportunities. Short-term rental yields is also an option. As Andy said, he was looking for somewhere to rent in the short term. During times of high inflation, we know that this drives rental yields, and certainly short-term rental yields, when looking for somewhere either for holiday or for a period of months, or if you're swallowing around the world, which we're seeing more and more of since the work from home. Finally, I think something we'll come on to, but buoyant rental markets in Europe, UK, US. This is based on real demand. What we're seeing, why people are moving around the place, why people are moving to alpha cities, why people are moving outside of London into the likes of, Birmingham, Manchester, and your cities, in Germany, for instance, Athens, within Greece. We're seeing a migration of people to the cities, and seeing an increase, or certain cities anyway, and seeing an increase perhaps where they can bring cost of living down, better lifestyle choices. There's a diversification to be had across Europe in terms of property. It's not just your traditional main cities, Frankfurt, London, and Paris. There's migration of people and moving of people to create more demand. And so as a foreign investor, there's a lot of opportunity at the moment. So some global factors to consider. Andy, I think if you can give us your thoughts here on what you see happening.
Yeah, so I think I'll talk a little bit around the first point. So we all know that the world is in an increasing and high inflation kind of mode at the moment. It's quite interesting reading the British press. They think they're the only people in the world having a cost of living crisis. Everywhere is having a cost of living crisis. I mean, it's just frightening how costs are going up everywhere. But I think it's important to understand that since the global financial crisis of 2008, governments have been printing money essentially, or buying their own bonds, or quantitative easing, whatever you want to call it. Just in such large markets, it takes quite a long time for the inflationary effect to come through. And then exacerbated by the COVID crisis, where a lot of first world countries paid enormous amounts of money to people to stay at home and not work. Somebody's got to pay for that. So the governments have all got really big debt piles, and one good way of getting out of debt is to inflate your way out of debt. So this inflation is not a surprise. Everybody's blaming it on the war in Ukraine. There's absolutely no ways. That might have been a contributor, but it is certainly not what's causing global inflation. There's no doubt that the petrol price or the oil price increase that's come through the sort of uncertainties and Putin kind of holding the world at ransom has definitely had an effect on inflation. But these inflation concerns, we were talking about them last year, before we even knew about the invasion of Ukraine. So I think it's important to understand that. And when you go into an inflationary environment, and you can take Zimbabwe as an extreme example, is when people had debt in their currencies in a high inflation environment, and they had debt against property, the amazing thing was that when you go into high inflation, your real estate prices also tend to start going up. And what happens is your debt actually reduces relative to the value of the property. So real estate is actually a really interesting asset class to hold in an inflationary environment. So all the noise about increasing interest rates, etc., is obviously concerning. It does suppress the asset prices a bit in certain markets. But if you take it long term, real estate is really something that does protect one against inflation. So I think that you need to understand that sort of relationship between interest rates and inflation. Obviously, the interest rates are going up to try and cool spending and to try and sort of reduce inflation. But the real factors driving inflation is not through consumption. So I don't know if these interest rate increases are really going to drive inflation down. I think inflation's around for a while. There is talk of a global recession. There's no doubt the world's in a difficult position at the moment. But if you look at all the big disruptive periods in history, people who held real estate did well. And you need to just make a decision at what percentage of your sort of entire portfolio it makes up. But it certainly should be part of your global portfolio. Just talking a little bit about factors to consider, maybe more at home if you are from South Africa, is that it's very easy to think, well, the whole world's uncertain at the moment, maybe SA is not so bad. But what we've got to understand in the SA context is take the emotion out of it and understand that we're an emerging market with a very corrupt government. We're also a commodity country, and in a world where demand is reducing for goods, that's not good for commodity prices. So you'll look at the rand is sitting at well over 18 Rand to a US dollar at the moment. That is actually quite scary when you think that in 2011 it was 6 Rand 75 at a stage to a US dollar. So if you look at the depreciation of us as an emerging market currency, it's really something that you need to hedge against. So if you have a portfolio in South Africa, that's great, but why not balance it with something offshore? And the other thing as well, a real fundamental, is that when you go into sort of developed markets, is that there is rule of law. And that's really important. So you're actually balancing not only financial considerations, but political. There's a lot of uncertainty about ownership in the future in South Africa. Whereas if you go to the UK, I mean, for centuries and centuries, you know, title of property is absolutely enshrined in that economy. You know, so yes, short term, it might look scary to go and invest in the UK, but I actually think the UK is quite cheap at the moment in global terms, because, you know, we all know what the British have been going through politically since Brexit. So, you know, don't discount these markets. Look at them and look for the little pockets of excellence. I'm just thinking unemployment. Let's put it in perspective. Unemployment in the UK is sitting at 3.7%. South Africa is well over 30%. So, you know, a recession, when you've got unemployment at such a low rate, relatively not a huge problem. So it's more comfortable, wealthy people who are starting to feel discomfort versus a place where 90% of people are actually living in pretty dire conditions. So just always understand the perspective from which you're looking, and that's always my advice, is and try not to read, you know, the mainstream media. Go and talk to people who actually make it their business to understand the true fundamentals of the market, away from the sort of regular news noise. Meg, maybe you want to talk about the second point.
Yeah. No, well, thank you, Andy. Appreciate that. And he's absolutely right. Brings us nicely into, you know, what we call investing for resilience. You know, we'll talk about it in our approach and strategy shortly, but you can't time the market. I think if it's something that you're ready to do, there's no point waiting out if there is a recession or if we think the market's going to come down. The reality is there is demand. We know that there is demand. There's demand from foreign investors for robust places within the UK. What we can do is look at investing for resilience in the short term, which is, you know, in your short term, which is actually looking at properties that offer a short-term let solution. You get a much higher yield in the short term. That might cover your short-term cost of capital, which would be higher than you would have liked. So maybe at the moment, you know, percentiles are 3% higher than they were on a fixed rate mortgage 6 months ago in the UK. So, you know, we can look at a strategy with you to find out how to sort of bulletproof you in the short term and future-proof you as well, and give you opportunities to find something. But entering the property market, I mean, there is no timing it. Andy, you know, quite rightly mentioned that people have done well out of recessions. You know, during the first recession, we know that pre-recession 2007 prices were high. You know, the primary home market or more discretionary market did come down, but we aren't often in the market over £500,000 or euros. We're referring to a much more fundamental market, which is, you know, those professionals who can't get on the property ladder just yet but are saving towards it. They need somewhere to rent. Whatever, if you've got a strategy to buy property and you're looking to hold the property for a long period of time, how your property price moves over 5-10 years can be quite irrelevant if your yield is growing, if you've bought in the right location where you're getting year-on-year increases in your rent. And we know that in the long term, when you hold property, then it is a viable asset with capital appreciation. And we saw that in the recession in 2008, where property prices were well and truly above pre-recession prices in robust locations by 2012. So I think it was about 40% above pre-recession. So there was, you know, a downturn, but major growth on the other side, because there's always pent-up demand. Foreign investment will come back, and primary homeowners will enter the market just as soon as they can. Everyone wants to own a property for themselves to live in. It gives you that sense of stability. So I think those are major factors to consider when either sitting tight or deciding if you want to enter the market. But talk to us about how we might be able to help you to mitigate some of that short-term cost, that capital cost, that interest rate increase. We can probably help. So we'll go on here onto ownership of property in prime locations. We're going to tell you a little bit about some of the properties and developments we've seen. Again, these are just examples. We don't necessarily hold stock. We do look at you as the purchaser and your profile and understand your objectives when it comes to purchasing and find property to suit you. But of course, we do have access to stock in and around the world at the moment. Main locations we're focusing on: Germany, Portugal, Greece. We can help in France, the UK, Mauritius, and we are launching the US shortly. So, we've got a plethora of choices. We've got the expertise, and I think that's our competitive advantage as a business, is that we can look cross-border, truly cross-border. So here we'll talk about a few properties. Andy, I think you might want to talk about the Rebelo in Portugal, and then I'll go on to introduce the others.
Thanks, Meg. Yeah, on the left-hand side in the bottom corner, you'll see that beautiful building. That's called the Rebelo. It's a 5-star hotel on the Douro River in Porto, in Portugal. So that's absolutely prime real estate. A couple of years ago, that was classified as a UNESCO World Heritage Site. So very little future development will be happening in that area. And our partners acquired this site probably 6-7 years ago. They were old port warehouses. So in the old days, when they used to bring the barrels down the river on the Rebelo boats, that's where they used to store them before they got exported. And these warehouses have now been converted into this wonderful hotel. And in the middle there, between the two warehouses, you'll see that block. Those are actually apartments there. And we have got, I think, 11 or 12 apartments in there that are now available to our clients. The construction is going to be complete in the next few months, and the hotel will be opening in Q1 2023. And that project is running a little bit behind timeline because of the delays during COVID with supply chain for the construction industry. That's a global issue, but they're actually finishing well, and that is a super investment. It's actually been something that we've been offering to our Golden Visa investors, but from a pure real estate investment point of view, where you can have a title deed and own an apartment, and Bomporto Hotels, who are going to be operating the hotel, have got 3 or 4 other very complimentary hotels in Portugal. They're running at close on 100% occupancy at the moment post-COVID. They're good operators, and we've got many investors in their other hotels, and they've done really well, both from a capital appreciation perspective, but more importantly from a regular monthly income point of view in euros. So that's been a super lot of investments, and we really are now at the tail end, and we've just released these 12. So that's certainly something to consider. Meg, I'll let you chat about the other markets.
Yeah. Interestingly as well, in Porto, I've been present in the Portugal market since 2008. Porto has limited space. Prime locations are very hard to come by. The Rebelo location is absolutely prime. And hotel accommodation in Porto, because of a lack of supply, is extremely expensive. Your nightly rate, I think, in many parts of Porto is in excess of 300 euros. So this will drive yield and lack of supply. It's a wonderful place to visit. People want to go there, so they will pay it. And I think certainly when you're looking at a hotel investment like this, it's a great way to hedge. Also, in and around Portugal itself, the short-term market is something to consider. The second development in the middle there, that is a project in Berlin, Germany, actually. And Germany is another place which there's been a huge increase in foreign investment since post-Brexit, when the rumors were that the banks were, moving out to Frankfurt. Developers jumped in. There was a huge amount of investment into Frankfurt. That has happened for many back office banks. They have moved support services and other services across, and it's created a demand for housing, obviously. And so therefore Frankfurt and Munich, property prices have grown extraordinarily in the last few years. Berlin is a touch behind on the price per meter. So I think there's still an opportunity to invest in Berlin into a good residential development in a central location. Rent control was an issue until recently. That has now been removed. There will still be a time before the local Berlin residents are able to enter the property market, as wages increase, as more job opportunities move to town, pushes wages up. So the rental demand in the short term is extremely high. Whilst the German market is cooling off at the moment, because the cost of living in Germany has gone up, cost of heating, this we know to be true. People are sitting on their hands a little bit. It's a good time to come in as a foreign investor. It's less competition, and more opportunity and more availability of properties to buy. Until recently, when a property wasn't lasting 24 hours on the market. So I think it's a good time. If anyone's interested in Germany, please let me know. Finally, on the right there, well, not finally, but one on the right there is Pavilion Wharf. That's a development. I'm sure many people have heard a lot about what's going on in the northern powerhouse of the UK. This is Manchester. There's been a huge amount of movement into Manchester. People are moving outside of London. Cost of living in London is high. Cost of rent is high. Manchester is a beautiful city. In fact, Andy and I were there in July, and it's come such a long way since I was last there. Beautiful restaurant offerings, amazing lifestyle, actually. A lot of green open spaces. Pavilion Wharf is one development that we found, which is actually on the river. And I think it offers a great location. It's a combination of a good developer, good construction firm, and offers a lifestyle aspect as well, with a gym, residence, garden, residents work from home. These are what we look for when we're looking at a robust strategy of what types of property to choose in locations that where you can get your best possible rental. So this is a good opportunity. Manchester is a great market. We know that there's a few universities, one red brick university in Manchester as well, which will bring students and retain students. There's a very high retention rate of students after they finish university to stay and work in Manchester, because the opportunities are there too. So this is a long-term investment strategy. Right now we'll see a huge amount of hype about it. That hype has substance, we know that. And we've seen a few investors very happy with their purchases and their ongoing rental yields that they're getting on their Manchester properties. Another option here, just something slightly different outside of the hype that you hear about Manchester and Birmingham. This is a development in Brighton is another one, and I keep saying it, but a robust location. It's extremely popular with UK residents for holidays. So it gets a huge amount of tourism. It's commuter city to London. It's on the water. It offers a lifestyle. So with that, it brings a huge amount of people. There's a population, there's a workforce, there's a kind of microeconomy going on in Brighton. This development is just near Hove Station. It's got a short-let opportunity and a long-let opportunity. And I think, we've looked at the numbers. The short-let numbers are definitely there. Brighton is very popular for a weekend away, family holiday, or to go into work. If you are working in London, you can still commute to London from here. So these are, another good opportunity that we've got for our clients. Just, the slide here, I think, is a few considerations when we're looking at properties to suggest for our clients. Obviously, we look at new builds. I think we've mentioned this earlier, but being a foreign owner does bring with it a level of complexity. So having a new development where you've got a good warranty from your developer for structural damage, or for your fridge, freezer, etc. You know, these are practicalities that you've got to consider. So new developments are a great way to actually mitigate your cost center in the short term in the investment. I say short term, it can be long term, depending on the length of your warranties, you know, to ensure that you know how much that investment is going to cost you, and then you can work out your yield and you can work out what the difference is. Other, you know, practicalities we look at are what the light and lifestyle is like from a tenancy point of view, what your finishes and furniture are. You know, we want to give our clients, our investors, the best possible chance of renting that property out, of having, you know, demand on the rental side, and then also consideration on the exit strategy. You know, buying a good apartment within the building with good finishes, work from home facilities, gyms, outdoor space, all of that, which will give an offering when it comes to selling it as well. Because if you do need to exit, we want you to be able to relatively easily. And finally, the old and the new. There's a huge amount of development in and around Europe and the UK and the US. It's very much up to, you know, your risk profile, what you're looking for, your objectives as to whether or not you want to buy new property. If you want to buy older or existing property, we can do that too. We also have a home buying service in the UK now, which if you are moving to the UK and looking to buy a primary property for yourself and your family, we can assist. We've got a team on the ground. And then on to our approach and our strategy, and I'll be quite quick because I'm conscious of time. We've said this, but property in robust location. We look at locations that have got historic successes, or why they'll have future successes. We've said this earlier: infrastructure, government redeployment of funds, and regeneration of areas. Reasons why human capital are moving to areas where they might create rental demand or upward pressure on pricing. Areas with a combination of homeowners and foreign investors as well. You know, this is a good offering. This is a good consideration during recessionary times. We want to know that there are people on the ground, people living there, even if there are developments built. And at the moment, you know, people are unsure whether or not they want to buy. These developments will then be rented out by the developers. And we know we've seen this during COVID when there was a little bit of a shake-up. You know, there weren't too many buyers at the market while people were considering what was happening. Developers rented the properties out. They then sold those properties with the tenants in place. You know, we can find these two for you if you would like. Yeah, and we said this, but if you're concerned about interest rate increases, then hedge by looking at property that's got long and short-term offering to get a higher yield. You can't time the market. So, you know, chat to us about what opportunities are available to you, and consider this a long-term investment strategy. And your currency hedge, Andy, you've touched this, is a major consideration as well. To be in euros, to be in pounds, or dollars, of course, in the long term, and earn your yield in these currencies. Our approach will provide you with options that meet your needs for financial stability and diversification. You know, we'll do this in a responsible manner. We have a global approach. As I said, this is our competitive advantage. We've considered the options. We've looked at pockets of opportunity, pockets of value. We've looked at the financials, and we've done our due diligence on the data. We want to help you invest in property in a responsible way, and in a location that, again, is robust, can hedge against long-term and short-term factors, and something to match your risk profile. We mentioned this briefly, but I'd like Sarah to speak here about a Plan B, a residency, and how that is associated with.
Thanks, Megan. So you may be aware that you can, through real estate or through a property purchase, also use that as a vehicle for a Plan B, for residency or for citizenship. It's important to understand that in certain jurisdictions this is available, but not in every jurisdiction. For example, purchasing real estate in the UK or in the USA is not going to allow you to qualify for any form of residency. In jurisdictions where it is possible, it's also just to understand the actual residency by investment, the RBI, or the citizenship by investment, CBI, the qualifying legislation that accompanies that property and real estate purchase. For example, in Greece, you can currently make any real estate investment into any location in Greece or on the islands, and it will qualify you for the Greek Golden Visa, provided that the minimum investment threshold is 250,000 euros. This enables you to secure Greek permanent residency. The market's actually even more flexible than that, in that you can purchase multiple properties to be able to reach that minimum threshold. There is legislation change set to come into force next year, which will look at restricting the areas to where you can to which you can invest, and also possibly is going to raise that minimum investment in certain areas or across the board. So it's really important to understand when you are making that real estate investment, what you are making it for. Are you making it for that offshore property purchase to hedge and to build your portfolio, or are you looking to ensure that you're investing into a qualifying real estate property that is going to allow you to pursue a residency or citizenship program? If we look back at Portugal, we've discussed that in a lot of detail on this webinar too. It's possible to qualify for the Portuguese Golden Visa through real estate investment, but the legislation is, there's heavy legislation into the areas which qualify for investment, and also the types of buildings that you can invest in. So again, you really need to understand what and where you can invest if your end goal is to secure Portuguese residency. In Portugal, there's very, very different real estate investment categories for the Golden Visa, with a minimum investment at 280,000, but then with different investment categories, different property types, different areas. You can invest 350,000 euros, 400,000 euros, or 500,000 euros. In other destinations, if you're looking at Grenada, which offers a citizenship by investment program, it's very important to understand that their real estate investment path is not actually into standalone properties, but that the real estate has to be into a government-approved development. So often these developments encompass real estate developments such as hotels, villas, resorts, because it allows the government of that jurisdiction to drive the foreign direct investment into projects which can yield a substantial number of jobs for nationals. And so often in certain jurisdictions, these real estate investments are actually structured as real estate investment trusts. But key to pursuing real estate with an RBI or a CBI end goal is that the investments have to be cash investments, or the minimum investment has to be a cash investment. It cannot be leveraged in the country where you're intending to invest. So that's an important differential between making your offshore property, building your offshore property portfolio and potentially leveraging funds in the jurisdiction to assist you, or if you're looking at that RBI or CBI end goal. I mean, from our side at Sable, we would look to understand your key objectives, looking to understand if you're purely looking to expand that offshore property portfolio, in which case you've got a much larger range of options available to you. But if you're looking to combine your offshore real estate with a plan B, then there's also options available to you, and we would discuss this in detail and understand your specific goals and motivations so that we can help guide you on what might be the program which best suits your needs. Thanks.
Thank you, Sarah. Moving on to you, Scott. I think let's let you tell everyone about the tax and structuring of real estate.
Okay, thanks, Megan. So I was asked to give a briefing on what the tax situation would be if you were buying a property as an individual or within a corporate structure. So I'm going to give you a bit of a whirlwind tour on how tax and accounting works in both of those areas. And obviously, if you've got any questions or concerns or anything about it, you can come back to us and we'll answer those. So the question I often get asked is, what is the best vehicle to buy a property? And just remember, I'm talking about the UK here too, since I am in the UK and it's UK tax. So the answer is, it all depends. So if we're looking, for example, to buy a property as an individual, now you need to realize first of all, there's no restrictions in the UK for a foreigner to buy a property in the UK unless they're on the sanctions list that has come out recently. Secondly, there is no restrictions on what type of property that someone can buy as well. So you can look at buying a rental property, an investment property for capital gains, for example, or even a place for you to stay in when you visit the UK. And as Sarah pointed out, just having a property doesn't mean that you're allowed to come and live in the UK permanently. When you rent a property out in the UK, 20% is normally deducted from your income that you receive. And this is actually paid over to HMRC, usually by your managing agents or possibly even your tenants. Now, a way to avoid this is to join a scheme called the non-resident landlord scheme. By joining that scheme, it means that you receive your money or your rent gross. Now, it doesn't mean that you don't pay tax on it, it just means that you receive it gross and you'll pay tax on it later down the line instead of when you actually receive your rental each month. Now, again, as a non-resident landlord and as an individual, you must file what's called a self-assessment or a personal tax return each year. This is filed at HMRC and it will show what your rental profit is, that rental profit being income received less any allowable deductions, and that actually has to be filed regardless if you receive a rental profit or a loss. Or, and this is where a lot of people get it wrong, even if you have to show your tax department in the country that you live in that you have rental income as well. So it must be filed in the UK. The tax year in the UK strangely goes from the 6th of April to the 5th of April, and then any tax return that is filed must be completed and filed at HMRC by the 31st of January of the following year. So let's look at buying a property through a limited company. So setting up a limited company in the UK is actually relatively easy. You don't have to be a UK resident to be a director, and you don't have to be a UK resident to be a shareholder. So in regards to setting it up, if the right information is provided and there's no queries, then most incorporations can be set up relatively quickly, within 3 to 5 days. It can be a simple structure. It can be a case whereby you have one director and you can also be the same shareholder. Or it can be a complicated structure where you have multiple directors and the shareholders, not individuals, but corporations or trusts, sorry. The individuals, as I said, do not have to be UK residents at all. The companies also need to have a registered office, and that office needs to be an address within England if you're looking to set your business up in England. That address is a public record, so if someone goes onto Companies House, they can see what the address is. So often we find that clients don't want their address to be shown at Companies House, so in that way they often use their accountancy firm, and for many, Sable's London office is the address that they use. Bank accounts. Now that is where things get a little tricky. A lot of the banks in the UK, whether it's a high street or an online bank, want you or want someone within your company to be UK based, whether that is a director and or a shareholder. There are some banks out there, mainly online ones, that do allow non-residents to open a bank account. But these can be quite lengthy, there can be quite a lot of compliance in place, and they can be expensive. So that is a point that you do need to keep in mind if you're looking at setting up a limited company, that can I get a bank account to operate? The company's year end is usually 12 months after the date of incorporation. So for example, if we incorporated a company today, your year end would be the 31st of October 2023. And finally, every year, financial statements and a corporation tax return need to be filed at HMRC. Company also needs to file what's called a confirmation statement at Companies House, and that is kind of like re-registering your company every year. So there's quite a lot of compliance in place when it comes to operating a company. So if we now look at the rental income and expenses, so As an individual, your self-assessment or that personal tax return must state the rental income and the expenses that you have, and then shows either a profit or a loss. You take the rental income, and then you allowed to deduct expenses which they consider wholly and exclusive relating to your property. So that would be things like utilities, your council tax, service charges, repairs and maintenance. Any improvements on your property are not deductible. And then the most important thing is, as an individual, if you have a mortgage, the mortgage interest is not 100% deductible. HMRC allow a relief of 20% on that. If we look at a company, pretty much the same applies, except one very important piece. Mortgage interest is 100% deductible for a company because it is considered a business expense. Everyone's favorite subject, taxation. For an individual, if you have rental income, you will pay tax at 20% up to 50,000 and then 40% over 50,000. HMRC does allow what's called a personal allowance, which is roughly about £12,500, which you can earn tax-free to start off with. This personal allowance is not available to everyone, but is available if you hold a British passport, if you're part of the European Economic Area, or if you're the double taxation between the country you live in and the UK has one in place. For a company pays tax at 19%, regardless of how high or how low the profit is. Unlike personal tax, there are no allowances for earning tax-free money. So basically from the first pound you earn as a profit, you will pay the 19%. The nice thing though within the company is that the profit, the retained earnings, doesn't have to be allocated out to the shareholders. So this can actually stay within the company and you can actually allocate that at a later stage. So let's say you've owned your property for a while and you're thinking, well, I might like to sell it now and get some capital gains from it. So again, let's have a look at it from a company side first, because that's a little bit easier.
Have we lost Scott?
Scott, we lost you briefly there.
Okay, am I back?
Yeah, you're back. Oh, apologies for that. Give him a second.
All right.
Okay, you're back.
I'm back. Oh gosh, I'm sorry about that. All right, where are we up to?
Load shedding.
Sale of property. Yeah.
Start again from capital gains, if you wouldn't mind.
Capital gains. Sure. Okay. So as I said, if you're looking at selling your property and that's owned within a company, what we need to do is look at what the selling price is set against the original purchase price. The asset is written out of your balance sheet, and then the gain that you make on the property is considered income within the company, and you pay 19% on that. It really is as simple as that. Don't have to do anything else. If you own the property as an individual, there is more actually work that you need to do. So non-UK residents must report the sale or disposal of interest in UK property, regardless if there is a capital gain or not. When selling the property, you must set up what's called a capital gains tax on UK property account with HMRC. You actually have to do this yourself, and while we can certainly assist with it, it is an account that needs to be set up in your own name. Within 60 days of the completion of the property, so that's actually where you are no longer the owner, you must inform HMRC through this online property account what the sale price was, what you purchased it for, if you've ever lived there, what improvements you've done for it, and then it works out what your capital gains is. That capital gains, if there is a liability, you have to also pay within 60 days. There is a capital gains allowance, roughly around about £12,000, similar to like the personal allowance that you can put against the capital gain. But within a company whereby you pay your tax at a later stage for an individual, especially when there's a capital gains, it must be paid within that 60 days. So I'll go back to my first question. So what's the better option? To buying as an individual or within a company structure? As I said, it also all depends. But if we have a look at just quickly at some of the advantages, say as an individual, you do not need to incorporate as a company and try and get a bank account. It might actually be easier to get a mortgage as an individual than through a corporate structure. There are a number of tax reliefs that you can get as an individual, depending on where you're from and the double tax agreements. And you only need to file a self-assessment compared to company accounts. As a company, you can claim full mortgage interest against your profits. You do not have to allocate the profits out to the shareholders. So as I said before, the profits can be retained in the company and you can pay them out to the individuals when you want to. The corporation tax might be lower too than what you end up paying tax as an individual, something to bear in mind. Finally, a company can own a multiple of properties within its structure. So to go back to that question, generally, I would normally say if you're looking to buy a property and it's only one property, then you're probably better off buying it in your own name. If you're looking at buying multiple properties, then a company structure is possibly the best option, but it does come down to your circumstances, what you're looking at or how you're looking at financing that, and also what your long-term plan is.
Thank you, Scott. That's awesome. Yeah, any questions? I see we've got a few on the right, but I think we have properly run over time. So the one question about the EU, Sarah, I think if you could just maybe get back to him directly. There's a question for you, Scott, just quickly. What would tax benefits be, i.e. personal vs company vs trust entities? I think that's important because trusts are quite popular in South Africa, but are structured more as companies in the UK. Scott, I'll let you answer that before I pretend.
Yeah, so trusts are interesting because obviously it comes down to the allocation of any money to the beneficiaries. So a trust will actually just pay, if it's a corporate trust, it'll pay the tax that it needs to pay paid on the corporate structure, and then any allocations that are made out to the beneficiaries will be paid on the individual rates for tax. So just beware that while I understand that trusts are quite popular within South Africa, they're not as popular in the UK as people think. And especially if you have a trust that's part of a lot more compliance that you have to do in regards to proving what the trust is for and actually who the trustees, the beneficiary, and often who the debtor is as well.
Thank you. Thanks, Scott. Another question here I see, would there be a difference in percentage in council tax payable on the second property as a company vs individual? Council tax is payable by your tenant if it's a property investment you're looking at. If it's a personal purchase, council tax is paid by yourself. It doesn't matter how many properties you own, council tax is based on just the council. And the only way to not pay council tax if a property is vacant is to remove the facilities, so your toilets. You have to make it unlivable. Must you set up a company in each country that you want to invest in? Scott, I know that you primarily do UK. We do have a team that can help with setting up your structures across Europe as well. Perhaps you can give some...
I think maybe I can just jump in there. So that's Dita. That's a good question. Every country will be different, because I think if you compare your current tax jurisdiction to what Scott's been talking about, every country approaches all the different taxes slightly differently, and I think it'll also have to do with, what quantum of investment you're going to be making to justify the costs and the benefits of owning the structure. But certainly, in our experience, is that if you're going to have a holding structure, it should probably be country by country. For instance, if you've got say an offshore trust that wants to purchase property in some of the sort of more socialist European countries, then, a lot of them don't recognize trusts, for instance, and they would then advise to rather set up a local company. Setting up companies in the EU is a lot more expensive than running a limited company in the UK, for instance. So I think that would probably just be an individual by individual conversation, but very happy to pick that up with you directly, Dita.
Thanks, Andy. Scott, a question for you. What is the dividend tax in companies when distributing the profits?
Okay, so basic dividend rates for, if you're what's called a basic taxpayer, that's generally you're earning less than 50,000, is just over 8%, 8.75%. And if you are a higher rate taxpayer, that's currently at 33.75%. They might change depending on how our next budget goes within the next month. So don't hold me to that, because they seem to be changing on a monthly basis here at the moment. But generally, if there is a change here, they were likely to drop down to what the original levels were. So let's take 1.25% off those months.
Thank you, Scott. And then we've got a question around stamp duty here. Again, this might change, but at the moment there is a stamp duty relief if it is based on how many properties you own worldwide, but if it is your first UK residence, it's a large relief. It can make a big difference in your purchase. The question is stamp duty on a second and third property across the UK. Depends if you're local or foreign, and it also depends on the property price, but generally there's a percentage associated with the price, and add 2% if you're foreign as a rule of thumb, but we would need to know the prices, etc., to understand what your tax implications there would be, right, Scott?
Correct.
Okay. That's all our questions. So thank you very much, everyone, for joining us. Just one last thing. We're going to be around the country. The sable herd is migrating to Durban, Johannesburg, and around Cape Town. We're doing a roadshow, everything, our citizenship, our foreign exchange, our tax teams. So all 12 suites will be around the country. So please let us know if you'd like an appointment. We'd be happy to sit down with you directly. Thank you. Thanks for joining. Thanks, panelists. I really appreciate you all taking the time to join me today.
Thanks very much. Thanks to all of you. And the expo that Megan just mentioned, it'll be the last week of this month in Durban, and then early next month, Pretoria, Joburg, Cape Town. So come and see us. Megan will have some really nice information. And I know, Sarah, you've got lots of interesting stuff. Scotty, you're not coming down? Just make sure you've got a good tax expert with us. Thanks very much.
Thank you, everyone.
Cheers.